Hey there, this is Nick and Andy. We're two gray beards, and in this episode we're going to address the events of this week in a special episode. And so what happened this week was, as we discussed on last Saturday in our extended review of the situation in Silicon Valley Bank, we anticipated that Silicon Valley Bank's depositors would get most of their money. It turns out they're getting all of their money, and to get it very rapidly. Turns out they got it extremely rapidly, and that there would be more additional banks that would be needed to be addressed. Signature Bank was closed over the weekend, and they got all their money. And then this week, we've been dealing with the fallout in terms of the central banks, the Fed in particular, and the FDIC, how they are going to manage and support the banks going forward. And they're going to do it in two ways so far that they've announced. And there is a third way that they will announce. The first is they're going to provide pretty much unlimited, but secret, in that no bank has a stigma if they show up for this program, to basically lend short-term money to the bank to meet its needs of its depositors as they leave the system. And that's called the BTFP. And that program is unlimited in size, and there's quite a bit of misinformation going on around about it in terms of how stimulative it is. We don't believe it's stimulative at all. It is a degree of confidence, but nothing more. In addition, they just announced that a consortium of the largest banks in the country are going to lend First Republic Bank $30 billion so that it can meet its depositors' needs. In both of these cases, the objective for the government is to allow banks that are experiencing deposit flight to delever, to reduce their assets, sell their assets, hedge their assets, and sell them, in order to get smaller as their deposits leave, but without it being a bank run. Lastly, they announced one additional program, which has not yet been determined, and that is we expect them to change the amount of insurance provided by the FDIC. And that should slow deposit flight as well. Anyway, that's what happened. All supportive of financial markets, all reducing the financial stability concerns in the United States. Nick, what happened in Europe?
Well, in Europe, we had for the umpteenth time a panic about Credit Suisse. This has been a slow car crash, which has been going on for the best part of 15 years, ever since the GFC, basically. And it looks like that will be resolved as well, either by a marriage between Credit Suisse and UBS, and or via short-term support by the SNB, the Swiss National Bank. So that is all calming down the situation in Europe as well, but these crises normally come in threes. As Warren Buffett famously said, you never find just one cockroach in the kitchen. So all these bad apples are now coming out, and the central banks, all of them, are scrambling basically to keep the situation under control. I don't see that this has macro implications at all at the moment, certainly not the Credit Suisse episode. Today, we had the ECB, of course, and both the governor and the vice governor were very clear that the ECB has a full and complete toolkit to deal with any contagion towards the European banks that might come from Credit Suisse, and that they don't believe there will be any. So I think the market is definitely calming down. Today was, volatility came down significantly in the bond market, both the US and in Europe. Things are being contained very reasonably, and I don't think there are any macro implications.
And the ECB statement?
The ECB statement was very much as expected. They had pre-announced a hike of 50. But the big change, and they delivered that pre-announced hike of 50, But the big change in my mind, although Christine Lagarde was adamant, let's say, that this changes nothing towards the future path of interest rate hikes or cuts, and that they have gone completely and fully data dependent, the change in narrative to me was quite telling. Insofar as 2 or 3 weeks ago, you had a slew of central bank governors who are members of the ECB, i.e., the Dutch, the Austrians, and the Germans, very much telling the market the story that not only are you going to get 50 in March, but you'll get another 50 at the meeting after that, and another 50 at the meeting after that one. That disappeared, i.e., we are going fully data dependent. And the other thing that I should mention, and that's important to know, is that they significantly reduced their inflation expectations for 2023, 2024, and 2025, least of all for 2025, but they reduced a good 25, 30 basis points, that one as well. So they see a quicker path towards lower inflation, but still inflation is above their target even in 2025.
Right. And in the United States, we mentioned last week that we are also going to have to pay attention to the CPI and the PPI numbers. Both of those numbers were on the warm side. PPI was a little cold, actually. And so, when if we've asked ourselves this question, which is what would the Fed do next week? And in our last video, we were pretty much in consensus that it's a coin flip, assuming a resolution of the SIVB thing. That happened. The data came in, wouldn't have changed that narrative. And the range was 25 to 50, and that was the coin flip. And now, after what we understand and having spoken to players in the space, was a massive delevering of hedge fund positioning that drove interest rates very low in the United States. In particular, any expectations of hikes have been completely removed from the market. And now the next meeting is now not quite a coin flip, but favoring 25 basis points, but the other side of the coin is not 50, but zero. And so
Yes.
that's a big change. And it's a concern. Markets actually have rallied. Equity markets bounced and rallied a lot. Nasdaq is almost near its January high after today's rally. But it's a concern that a zero would, to me, represent a big shift because the data still supports 25 to 50. Nonetheless, that's where we are. And I think, Nick, it's going to be 25. Nick, what do you think?
I think it's going to be zero. And I'll give you my reasons. Look, if SIVB had not happened and there was not a continuing danger, as we mentioned, Republic National and so on, the Fed, I believe, is a highly political animal. And although the data does not support zero, we had more unemployment numbers today, which were strong. So the economy is strong. There isn't a single number that comes out and says, "Oh my God, we are in danger of imminently going into recession." Not a single one. And the Fed should do 25, but I believe they will err on the side of caution and have some kind of a press statement or a presser by Jay Powell, which makes it perfectly clear that they have not abandoned their inflation fight. It's just that they want to give the long and variable lags time to work on the economy. I think it's important that there have been several studies, or whatever you like to call them, primarily by Goldman Sachs and others, which have argued that what has happened to the regional banks is going to basically tighten financial conditions by between 25 and 50 basis points. So the Fed, if it wants to, has an argument to come out and say, we are doing nothing now, changes nothing about our future path of interest rate hikes data dependency. But what it does do is, because we factored in that this episode has in fact already tightened financial conditions, and we don't want to add more hikes onto the tightening of financial conditions. And we'd like to give ourselves some time to evaluate future data.
Yeah.
But it's a coin flip between 0 and 25.
Right. And we've looked at our portfolio. As we mentioned on our last episode on Saturday, we were going to offer our IEF intermediate term bond position higher, and we were going to offer our the remainder of our TLT position higher, and we were going to bid for some equities in case there was a big sell off if the if the Fed didn't take care of the SIVB situation. We've sold our bond position. So we're now at 0% nominal bonds. And I think whether they go 0 or 25 next week, that's the position to be in given the pricing.
I would agree. I on 0, I don't think that the long end likes it, or likes it less than the short end. The short end will rally because it's a, Pavlov's dog response. So maybe the long end rallies a tiny bit, but I would not be a buyer of it. I think the yield curve will go back to where it was, 2 weeks ago. So I'm not a buyer of long term bonds. If they dip enough, I think we will think about it, but that is something that we should talk about after the Fed. And why not have an episode after the Fed and tell our subscribers what we think we are going to do after the Fed?
Right. I think that's a good idea. Instead of having an episode 2 days from now where we repeat what we've said, we're going to delay the normal weekend episode till after the Fed and then get back on schedule after Wednesday. So the next time we'll see you is Wednesday. Nick will go. Are you going to go through the portfolio a bit,
I
Nick?
will do. I will do today. The one thing that I would mention is that we don't see any need to change our portfolio until we've seen what the Fed's response is.
Yep.
We see no macro implications here for the time being, do we?
No. We're long 30% equities. We're overweight gold. We have some commodities. Those are all fine in the event that we continue to rally a little bit. And nominal bonds are just too rich to own right now. I think and we still have plenty of cash. I think that's a perfectly fine place to be until after Wednesday.
I think that I will leave the bid in the SPY just in case that it dips. I think the odds are practically zero at this stage, all the way down to 37.50. But I much prefer equities at the moment to bonds. We shall see how that develops. The one thing that we haven't mentioned is the oil price. The oil price was down quite significantly this week, and that has some people concerned about the future strength of the economy. I am not so concerned. What do you think, Andy?
Well, there's no evidence that the economy's slowing at a more rapid rate. It seems to be slowing at a rate that is very reasonable. And I think just like the very short end of the yield curve, there was a lot of offside positioning. There were long oil against a China reopening. There were long commodities against China reopening in the metals. There was economy's very strong. Fed's going to keep tightening exposures in the short rates. And all of the people that had those positions were the same people.
I
And
think
so
you're right.
I think they just got pushed out in a very meaningful way. And that was really more than the story of is the economy, nothing happened. We
Yeah,
had some financial
I
chaos.
agree with you. There was a whole load of hedge funds and CTAs who got liquidated. And when one side of their trade blew up, i.e., the short end, i.e., the euro dollars, the sofas, and stuff like that, they got taken out of that. And then they decided to liquidate everything they had, or they had to, and therefore oil dipped for that reason. So I think oil is becoming interesting
I do too.
at these levels,
Commodities
and that's
broadly.
probably going to be something that we'll be buying depending on what the Fed does. But if the Fed does nothing, I think that the economy is going to grow just fine over the course of the next 6 months. And then oil, energy, and things like that are going to be interesting for the next 6 to 9 months.
Do you want to put a bid in before we talk to our audience next?
It's. I don't think it's worth it. I think we will talk about it on Wednesday, and then we'll decide what to do. I think that's the easiest thing to do.
Sounds good, Nick. Talk to you Wednesday. Have a good
Thanks.
vacation.
Thanks to everyone, and I'll run through the portfolio now, and otherwise I'll speak to you on Wednesday. In terms of the portfolio, there is very little to report apart from the sale of the TLT and the IAF. We are at zero. So overall, the allocation in bonds is really only 15%, as you can see, and equities the double. We have some cash. We have a lot of cash. We have about 45% cash, and we will be putting that to work very soon. I've updated everything else. You can see from the order entry that is left is that the only order which was left from last week is to try and buy S&Ps at 375. Never got anywhere close to it. Very strong market for the time being. We'll leave it there, but as we discussed, we will be back to you after the Fed and we will discuss the next steps. Thank you very much.